Welcome to It's the Economy. The interest rate and growth pieces have changed rather dramatically in the global kaleidoscope. We have not seen 4.35% 10-year US rates for 16 years now. 2007 was last when we saw. On the other hand, US and Indian growth look fairly resilient despite the high rates, while China is slowing much more than anyone expected. Where does all this leave India as an investment destination? Is this well and truly an India decade? To answer some of these questions, I have with me probably the best in the business, an expert on global macros and markets, Jitania Kandhari, Deputy CIO Multi-Asset Growth at Morgan Stanley. She also heads the macro and thematic research for emerging markets. Jitania, pleasure, and thank you very much for coming by to the studio.
Thank you for having me, Latha.
Okay, let me start with what's really hit us, this 4.34% US yields. Initially, when Fitch made its downgrade, it looked like, it'll go above 4 and come back. But it looks like it's staying there. What's your sense? Are we in for higher yields for longer?
Yes, I mean, I have been of the view that, a Fed stays higher for longer because of the stickiness on the wage inflation side, which is just not consistent with the 2% target. And the long-term yields with that inverted yield curve were way too low. So you had an economy growing at 2%, you had job growth, you had credit spreads that were tight, and you had this Fitch downgrade with a lot of issuance coming up, and the marginal buyer now not being the traditional banks, and the foreigners also bringing down their demand for treasuries. So I think all of this is going to lead to slightly higher, I wouldn't say dramatically higher, but I think getting to like a neutral with the CPI, because if CPI settles at about 4.5%, a nominal yield of 4.5% is not abnormal by historical standards. So I think this stays higher for longer. We are in a regime shift, and we really need to adjust to this kind of interest rate regime going forward.
A year ago, we made these journeys above 4%. The US 10-year did do that, but it came back, and that's why as recently as June, it was 3.5, 3.5. But you're saying now we better be prepared for 4.5 for a goodish bit.
Yes, I do think, because I would get worried when real rates, which is nominal rates minus CPI, get into extremely positive territory. And we are still kind of neutral there. So what happens is when real rates go up, even historically, during 1860, the Civil War, during the World War I and World War II, debt to GDP exploded, just like debt to GDP in the public sector has exploded in the US now. The only way out of that situation was negative real rates. And we have to inflate out of that debt. And so if we are in that neutralish territory, I wouldn't be really actually too worried on the impact.
Okay, but impact on equities, for instance, you always discount valuations as the opposite of interest rates. So if we have to get used to 4.5, will there be an impact on EM equities, equities in general, even allocation to equities, because debt looks attractive?
Yeah, so I think, Latha, there's one interesting thing. In the beginning of the year, there was so much extreme bearishness on the US economy, a one-way consensus bet, two consensus for comfort. That's shifted, and that's why the markets have not done so badly. But I think from here, just overall, every year in the US markets, you have an average median drawdown of about 11 to 13%. This year, we've drawn down only 7% during the SVB fallout in the first part of the year. So to expect even a normal drawdown is, that's baked in our expectations, and that's how we're positioning. And on the yield side, I think for the first time, corporates and households are able to earn 5% on short rates. So I don't think fixed asset investors are really going to buy the long end in the overall asset allocation portfolio at this point till you really see that adjustment in the price, or I would really be a buyer when that real rate number starts looking concerning. So yes, I do think that there is going to be a drawdown in equity markets, just in line with normal yearly averages that we've seen in the past.
Fair enough. Okay, now let me before I come to the India story, which I want to ask you, just a word on China. I mean, with each passing month, the disappointment is only increasing. The property problems are not going away. Evergrande has, already filed for bankruptcy. So what's your sense? Do you think this is a longer-term downturn in China?
Yeah, I mean, I am concerned on China. I think the three issues with China, to sum it up, is one, it's overinvested, it's oversupplied, and it's overleveraged. Yeah, India is the opposite. We can talk about that. So I think in that situation, any stimulus that is being put in place just doesn't have the firepower like the past. China has stimulated 4 times since the global financial crisis in 2008. This time, the fiscal stimulus the impulse is the least. There's just nothing left in that stimulus tank because of all these issues. And more importantly, the private sector confidence is collapsed. So in the past, every time China stimulated, the private sector doubled down. If China said buy houses, households bought houses. If China stimulated infrastructure and public investment, the private sector doubled down. And this time that confidence is not there. And because there are chronic issues, and as you brought up the property sector, which by estimates is nearly 25% of the economy, that sector, the government finance vehicles, what a very important part of that sector, because they sold land to property developers, they got the revenue from that land, and they invested those proceeds in infrastructure. Now they are not able to sell that land to property developers because the government is trying to right-size that sector and not stimulate it. So that's part of that same machine which is completely clogged. So even in this situation, their money supply is double that of nominal GDP growth. And first time China's nominal GDP growth has collapsed in sync with the real GDP growth. Where are the earnings going to come? So I am worried on the economy there.
Okay, so this is going to stay with us. Oversupplied, overinvested, overleveraged, and money supply also oversupplied. Okay, now let me come to the India story. I mean, it is a consensus trade. We just heard our colleagues speaking to even Japanese investors who are not very common. So do you think that this India story looks very good?
I really do like the India story. It is a structural story. It has whatever's not working for China, in summary, is working for India, right? It's not overinvested. It's starting a cycle. It's not oversupplied. In fact, capex is down, and it's not overleveraged. The balance sheets of the corporates all clean. So yes, you need all these building blocks but I really do want to see the sustaining of this growth, which has to come from, increasing India's share in global exports, increasing manufacturing to GDP. I hear it everywhere while I've been here with Apple, with chemicals, with defense equipment, etc., with pharmaceuticals. I don't see it in the numbers. I really do want to see that FDI to GDP, the manufacturing to GDP pick up. Female labor participation is abysmally low. Even Saudi has overtaken India in the last few years. And finally, the fiscal deficit is still the worst combined in emerging markets. So I just hope with this election cycle coming up, there's no welfare spending that further, causes that deterioration in that.
Actually, as you speak, those charts are running. As you can see, India at minus 8.9 is much higher than comparable countries, especially EM countries, in fiscal deficit as a percentage of GDP. And likewise, as you said, FDI as well, it's only, 0.8%?
Yeah, FDI is 0.8. Some of the Latin American and Eastern European economies have much higher FDI as a share of GDP. And what's interesting is the last few years that FDI has actually reduced, even in India, pretty significantly. So I'm not saying that I'm bearish on India, but I really do want to see all these pieces adding up so that we could see the sustained decadal growth that we are all hoping for. And the only thing I'd say, it's just become such a consensus trade. And you don't really always love a consensus trade.
Yeah, consensus trade can have, it's like, who else is left to buy if everyone is already bought? Could be a worry. But things are, the macros otherwise, as you say, current account deficit, inflation, growth itself are all working in favor of India at this point in time. But now let me start with sectors. You just spoke about how the rates can remain high for long. if they are that high in the US, 10-year is at 4.5%, say, for the next 1 year, then is it likely that Indian rates can fall at all? Is there any scope to cut rates in India? And if that is the case, this consensus trade of financials, everybody wants to own banks. Do you think that that is at its, is peaking off?
Yeah, so, interestingly, I think this whole rate cutting cycle in emerging markets was a phenomena for the first part of the year, right? Countries like Brazil raised rates 13%, they're unprecedented levels, because EM central banks have really been orthodox in their monetary management, unlike the past, which is why even though now Treasury yields are backing up in the US, some of these EM local debt markets are actually doing fine. They're not behaving like in the past. So I think that story on rate cuts, a bulk of that is spent, because now with Fed rates being higher for longer, the interest rate differentials will start mattering at the margin. In terms of the impact of interest rates on banks, we've done a lot of work on this. And what's really interesting is in some countries, the bank's net interest margins actually benefit with interest rates going up. And in some countries, that works the opposite. So interest rate cuts are needed to start the loan growth cycle. So I'm a little mixed on that. But I do think that there can still be some cuts in emerging markets.
No, but what I mean is that you like interest rate sensitive stocks. You like banks in India. Is there something else you can give our viewers?
Yeah, I do like the industrial theme globally, right? Because I think there are, I call it the 4 C's of CapEx globally, right? There is defense CapEx, there's green CapEx, there's resiliency CapEx to build supply chain, and there's substitution CapEx because labor is so expensive overseas that you need to substitute with capital. So the industrial theme is a big theme, in my opinion, globally. And some of those stocks are holding up. They are expensive in some parts of the world. But as a sector, I think you always want to buy areas where the world is underinvested. So I think that's another sector I really like.
Just one final question. Services exports. It looks as if the middle office everywhere is moving to India. GCCs,
Morgan
global.
Stanley as well.
Exactly. So you think that, how will you play that theme in India?
So I think that theme is a play on consumption, right? On housing, because that will create housing. It will create consumption. It will create financial services. So I think it all kind of stimulates the overall growth story. And what I hear, interestingly, even from our offices, is that now they are finding even better skilled employees. So work in India, made in India, now with, Gift City, invest in India, invest from India. I mean, they're all great steps.
Okay.
All good.
So maybe this one's the consensus is right after all. Jitania, it's a pleasure having you with us in the channel. And we are ending it on a high note, wrapping up on Bazaar. Chartbusters up next.